Welcome to the Deep Dive, your shortcut to being well-informed.
Great to be here.
Today, we're taking, a full plunge into a financial philosophy. It's not about flashy returns, maybe.
Not at all. It's about enduring wealth.
Exactly. We're looking at a surprisingly simple, low-cost, and really disciplined way to invest. It kind of flies in the face of all the Wall Street noise.
It really does. Complexity gets pushed so often.
Our guide for this deep dive comes from the wisdom in the Boglehead's Guide to Intelligent Investing.
A fantastic resource. Inspired by John Bogle, Vanguard's founder.
Yeah, it offers this really accessible roadmap for anyone, looking to build long-term financial security. Our mission today, let's pull out the absolute core ideas for you. How to avoid the usual traps, the emotional roller coaster, and instead find a clear, rational path. Finding clarity, really.
And that's the key insight, isn't it? So many people think investing has to be complicated, like you need some secret sauce or crystal ball. But the Boglehead way suggests the opposite. I guess, the powerful truth here is that real financial independence often comes from just unwavering simplicity, not fancy moves.
Simplicity.
We'll explore how keeping it simple, keeping costs super low, being tax efficient, and just focusing on the long run, how that can be your best strategy.
So interestingly, the journey doesn't start with picking stocks. It starts with us.
Exactly. Within ourselves.
That really struck me preparing for this. The Boglehead's philosophy is so foundational. It starts with you, your mindset. It kind of shifts the power, doesn't it? Away from the markets and onto your own habits.
It does.
They really hammer home that saving isn't just like a nice to have, it's the absolute bedrock of wealth.
The absolute bedrock. Couldn't agree more.
It's not just about how much your investments grow, it's about how much you consistently put aside. I mean, even amazing returns won't build much if you're not saving, right? If you don't live below your means.
You need fuel for the fire. Saving
Yes.
is the fuel.
And tied into that foundation is getting rid of debt traps.
Oh, crucial.
The guide is super clear. Pay off high-interest debt first, now.
Think about it as a guaranteed return. Risk-free.
Yeah, sometimes 15, 20%, maybe more on credit cards.
Exactly. Every dollar you stop paying in interest is a dollar saved. That's a fantastic return before you even think about investing.
And then, setting clear goals. Why are you even investing?
Your why.
Retirement, kids' education,
Yeah.
financial independence sooner. Defining that why isn't just fluffy motivation.
No, it's strategic.
It's the only way your investment strategy actually matches up with where you want to go in life.
That's such a critical point.
Yeah.
Let's zoom out for a second. These aren't just random tips.
Right.
They're the foundation that lets any investment strategy actually work. Without that solid ground, the saving, the debt elimination, a clear why, everything else is just, it crumbles.
Like building on sand.
Precisely. Like building a house on quicksand. It won't last. And, this brings up another vital piece, that emergency fund.
Yes, the safety net.
Totally indispensable. It stops you from rating your long-term investments when life throws a curveball.
Like a big car repair bill or something unexpected.
Exactly. It protects your whole long-term plan from getting derailed. It builds resilience.
Okay, build the foundation strong, then build the house. Makes perfect sense. So, speaking of building, this is where the Boglehead approach feels almost too simple sometimes.
Yeah, it can feel that way.
They argue so strongly for keeping costs incredibly low and just embracing index investing.
Which is counterintuitive, right? We're always told to pick the winners.
Exactly. But the guide makes this powerful case. Investment costs don't just nick your returns a bit. They compound against you.
Just like returns compound for you. Fees work the same way, but in reverse.
Over decades. High fees from active funds, maybe some advisor fees, trading too much. It just silently eats away a shocking amount of wealth.
That's like trying to run that marathon with heavier weights added each year. It slows you down dramatically over the long haul.
So what's the elegant solution they push?
Low-cost index funds and ETFs. Exchange-traded funds.
And why those specifically?
Well, it's simple, really. Most active managers, the pros, trying to beat the market by picking stocks.
Yeah.
They just fail to consistently do it after you account for their fees. The evidence is overwhelming.
So they charge you more but don't deliver more, usually.
Pretty much. An index fund doesn't try to be clever. It just aims to track a market benchmark, like the S&P 500 or the total U.S. stock market.
Passively.
So you get instant diversification.
Instantly. Across hundreds, even thousands of companies. Plus, very low turnover, which means fewer taxes usually. And minimal fees because there's no expensive management team trying to outguess the market.
You basically own the whole market.
You capture the overall growth of capitalism, essentially. And you drastically cut the risk of picking the big losers. It's almost, well, you said it, forget it.
It's amazing how just a small percentage difference in fees.
Oh, it's colossal over a lifetime. Think about a 1% extra fee. That's not just 1% less return this year.
It's giving up decades of compounding on that 1% difference.
Yeah.
That can mean hundreds of thousands of dollars less for retirement. It's not just a cost. It's a silent wealth killer.
Wow. Okay.
And the beauty of this simplicity isn't just saving money. It also cuts down on mistakes. It cuts down on stress. It cuts down on the time you waste worrying about investments.
Keeps you from tinkering too much.
Exactly. Those complex products, hedge funds, commodities, whatever's exotic this year, they usually benefit the seller more than the buyer. They add risk, complexity, and often huge fees.
So what's the simple alternative they suggest?
For most people, the guide suggests a simple 3-fund portfolio is often all you need.
3 funds. That's it.
Often, yes. A total U.S. stock market index fund, a total international stock market index fund, and a total bond market index fund. Boom. Broad diversification, low cost, market returns. Done.
Okay, that compounding loss from fees, that's a real eye-opener. It really shows why simplicity and low costs are just vital.
Imperatives, really.
So, shifting from what investments to use, let's talk about how you actually structure the portfolio.
Right. Strategy, asset allocation, and diversification.
The guide puts huge emphasis on this, balancing growth stuff, like stocks, with more stable things, like bonds.
Stocks for the long-term growth, the capital appreciation. Bonds traditionally for stability, income, and smoothing out the ride, especially when markets get rocky.
And finding the right mix for you is key, based on your risk tolerance and how long you're investing for.
Absolutely. Younger folks, decades away from retirement. They can usually handle more stock exposure, more volatility, because they have time to recover from dips.
But as you get older, closer to needing the money.
The usual advice is to gradually shift more towards bonds. For stability, capital preservation, protecting what you've built.
And it's not just stocks versus bonds, is it? It's diversifying within those two.
Yes. U.S. stocks, international stocks, different types of bonds. Spreading your bets, basically.
Yeah.
Reducing the risk that any single market or sector crashing tanks your whole portfolio.
This raises a good question, then. Are you really optimizing every single dollar for your own situation?
That's the goal. Looking at it broadly, asset allocation isn't just about risk management. It's dynamic.
Yeah.
It aligns your portfolio with your life stage, your goals, your comfort level.
Building an engine that can handle different weather.
Exactly. And then there's tax efficiency. Often overlooked, but so powerful.
The tax man.
Yeah, this isn't about dodging taxes illegally, obviously. It's about smartly placing your investments to maximize what you actually keep after taxes over many, many years.
So what are the key strategies there?
Well, the Bogleheads point out things like putting tax-inefficient investments, think bonds or REITs, which often generate income tax at higher rates, put those inside your tax-advantaged accounts, like IRAs, 401k.
Okay, shield them from taxes.
Right. And then keep your most tax-efficient stuff, like broad stock index funds that don't trade much, keep those in your regular taxable brokerage accounts, minimizes the annual tax hit.
And avoid unnecessary trading.
Definitely. That just triggers capital gains taxes, often year after year, chipping away at your returns. These aren't super complex moves. They're just smart, disciplined choices. But over time, huge impact.
It really shows how every little bit adds up, especially with compounding. And that brings us to maybe the hardest part, the behavioral side, staying the course.
Ah, yes. The psychology of investing.
Yeah.
Often the biggest hurdle.
The market will go up and down. That's just normal.
It's inherent. Expected.
The guide really stresses that downturns aren't disasters to run from. They should be seen as opportunities, maybe. Buy more when things are on sale.
If your plan allows, yes. Rebalancing can do this automatically. But the absolute worst thing, panicking and selling low in a crash.
Or the opposite, right? Getting greedy, chasing fads when everything's soaring.
Equally dangerous. The core message is just unwavering. Make a solid plan, commit to it, and then stick to it through everything. Just rebalance now and then to stay on track.
Be the captain, steady through the storm and the calm.
Well put.
The guide also lists out all these common mistakes investors make, things to actively avoid.
Oh yeah, driven by our own emotions mostly.
Like chasing those hot stocks everyone's talking about.
Or thinking you can time the market perfectly, get out before the crash, jump back in at the bottom.
Which almost no one can do consistently.
Right. And tuning out the financial media noise.
Yeah.
So much of it is just noise,
Yeah.
contradictory, short-term focused.
Getting overconfident when things are going well, trading too much, racking up costs and taxes.
And forgetting about inflation and taxes, just silently eroding your real returns over time. These are the subtle enemies. You have to be vigilant.
It's really fascinating how our own psychology often works against us financially.
It really is. Fear and greed are powerful forces. They make us want to do the exact opposite of what a smart, disciplined plan requires.
So the core Boglehead philosophy, it kind of boils down to a few key things.
A few powerful, actionable things. Save early, save often, live below your means. That's number one. Develop a sound, diversified plan using those low-cost index funds we talked about. And then stick to it through thick and thin.
Keep it simple.
Keep investing simple. And critically, stop trying to outsmart the market. Just let the market work for you over the long term.
And it's broader than just the portfolio, isn't it?
Absolutely. The guide brings in holistic financial planning, getting your insurance sorted, health, life, disability, property, protecting yourself against major risks.
Estate planning too?
Yeah, wills, trusts, making sure your beneficiaries are set up correctly, making sure your wishes are followed, and importantly, passing on financial literacy, teaching your kids, your family.
It's about the whole financial picture, your whole ecosystem.
Your entire financial ecosystem and future well-being.
Exactly. So let's bring it all together. What does this mean for you, the listener? This deep dive into the Bogleheads guide. It's clearly not about get-rich-quick schemes or beating the market.
No magic bullets here.
It's a solid, evidence-based roadmap for building wealth patiently, systematically, intelligently.
By doing things you can control.
Controlling your costs, diversifying widely, staying disciplined no matter what the market's doing, and just avoiding speculation.
Leveraging the long-term power of capitalism itself, instead of trying to gamble against it.
It's quite profound in its simplicity.
It really is. This deep dive, I think, shows a powerful, maybe counterintuitive truth. Real financial independence isn't usually found by chasing complexity. It's found in embracing a radical, unwavering simplicity and discipline.
So the final thought to leave people with?
Yeah, maybe ask yourself this. What would your financial life look like if you truly committed to this long-term, low-cost, disciplined path? If you really let the market work for you, instead of constantly trying to outsmart it.
Imagine the peace of mind.
Exactly. Imagine the peace of mind that comes with knowing you're on a proven, sensible course.
That is a powerful question to reflect on. Thank you for joining us on this deep dive.
My pleasure.
We really hope these enduring principles from the Bogleheads Guide inspire you, maybe empower you, on your own path to lasting financial security.